Our next guest sees Microsoft as a bright spot in technology, a group he is underweighting right now. Adam Parker is the CEO of Trivariate Research. He was the chief U.S. equity strategist at Morgan Stanley, of course, as you all know. Adam, welcome back to the show. Great to see you.
Good to see you.
So what do you make of all this market action? I mean, the volatility has been extreme over the past couple of days, and the comebacks have been extreme as well.
Look, I mean, to me, this is just a classic growth scare. I think maybe I got a few gray hairs in my head, so I've seen this many times. I think it's our 12th kind of 10% plus sell-off in equity since the financial crisis. So, I think you have to look at what's causing it. I think clearly the beginning of it was a perception change about rates. And now I think you just have a growth scare. People are worried that maybe earnings won't be higher, next year than this year. And I think that's pretty common. I think what was just said by Jeff, I totally agree with, which is we studied what works following growth stock sell-offs, and it's positive free cash flow and margin expansion. So businesses that do have that tend to outperform, and it's the profitless software that high multiples that can probably still go lower and will.
Adam, it's Tim. So what changed for you in the last month and a half in terms of what's the multiple you're willing to pay? And I'm not suggesting that you changed, and maybe, in fact, you've been more cautious. You've certainly come on here and generally been bullish, and you've been bullish over your career. So what is it investors should take? Was it that Fed turned on a dime? Because ultimately, we were willing to pay 35 times for Microsoft 2 months ago.
Yeah, look, I mean, I think ultimately I always think about U.S. equities as, I get some kind of 2 to 3% dividend plus buyback. 35 of the 500 companies in the S&P get kicked out every year, and 35 replace them. The replacement ones grow way faster than the ones that get kicked out, so I get another 1 to 2% from that, and then I get some sort of organic 3% growth. So I view it as like an 8% kind of total return algorithm. That looks better than every other asset class, and generally you're right. Basically, since the financial crisis, I've liked equities. I think what causes you to get bearish should be that you're worried earnings will decline. You're worried that there's a lot of management arrogance gone awry, too much inventory, too much capital spending, too much hiring, too much fancy new corporate headquarters. And in aggregate, I don't see a ton of that right now, right? So I think people are just worried about inflation causing earnings declines, and I don't think that's the case. My own personal opinion is the Fed will not act anywhere near as much as people think. So I don't think there's going to be whatever the big houses have 4 hikes this year and 4 next year. I'll take the under, and I'll take the under in a big way. It's interesting today, IMF comes out with a GDP forecast cut, U.S. and China. VIX is at a 1-year high. There's a risk-off trade. Financial conditions are the tightest they've been in a year. You really think the Fed's going to raise 8 times in 2 years on that? So all it'll take for a reversal is a directionally dovish comment, and then you'll get a NASDAQ up 4% then, right? I mean, that's what it feels like to me anyway.
So basically, Adam, you're saying that that the Fed will actually back away from the path a little bit based on a market sell-off. So the Fed will be influenced by what the market is doing if we sell off hard enough.
Yeah, for sure. I don't think anyone would disagree with that. I certainly don't think that they're dumb, so I don't think they're trying to cause a recession on purpose. So if you get a slowing GDP and you get some move lower in inflationary pressure, why would they raise a bunch of times? Look, I still think there's tons of stuff you can long and short in this tape, and that's the part that's exciting. When I did my outlook a couple weeks ago, we identified a bunch of things we like, and I still like them. Obviously our biggest call last year, was energy, was our top pick, and it is again this year. I just see huge dislocations there, and I like energy a lot as with demand supply imbalances. So I think investors should be looking at oil-sensitive names, and I still think that's the case. We've been underweight tech, a little bit worried about the profitless businesses. We pitched Bill.com as a short a couple weeks ago, but that's microcosm, Ceridian and others. They traded huge multiples and have negative free cash flow with accelerating revenue. That's not the right, cocktail at this, bar, so to speak. So there's definitely things to buy and sell.
Yeah, I want to ask you about Microsoft because you did mention it in the lead in terms of it being a bright spot for you in a sector that you are underweight. Do you look at Microsoft, though, in names of its ilk that are quality names in that they have the free cash flow, they have the margin ability to, maintain margins, et cetera? Do you think that these names still get re-rated in this market environment? Or do you think that these pullbacks are blips?
I think in the broader, 6, 12, 18 months, they're going to all be buying opportunities for these kind of names. We pitched one with Salesforce.com. I use both Microsoft and Salesforce in my business. What I'll tell you is they have pricing power, right? I do all my compute and store it on Azure. I'm in that Microsoft Carrizo. I use Teams. I use Office. I can't function without it. Can they raise pricing on me 7% per year? Yeah, they can. Okay. So I think when you look at those businesses, they are going to trade at premium multiples and on cash flows and earnings as you look forward. And they have lots of ways and levers to pull. So are they going to be better stocks than average over any meaningful period of time? Of course they are.
All right. Very Peter Lynch of you. Adam, always good to speak with you. Thank you.
Yeah, good to see you guys. Have a good one.
Adam Parker of Trivariate. Bonawyn, how are you feeling about Microsoft? How are you feeling about the markets here? Do you think we are in for a re-rating of technology?
I think we've already seen a re-rating of technology. So yes, I mean, certainly. With that said, I mean, I still have a hard time having a fundamentally bullish thesis and being overly bearish on tech. And I've said it time and time again. I think that the overvalued negative free cash flow names that are priced on a multiple of revenue, I do think that those are going to suffer. At the end of the day, though, I do think technology, it rings true in every pocket of every industry, and ultimately, there is a bottom there. And so, yes, I think we have seen a re-rating. It's a multiple that you're willing to pay for it. But fundamentally, I think the two go hand in hand.
All right. Check out our chart of the day here. Gold hardly moving despite the recent market volatility. Karen, you actually flagged this. It's a head scratcher.
I mean, I never quite got gold, but I think that if this isn't the time for the gold story to really work, which is we have inflation, we have uncertainty, we have commodity price, well, that's tied to inflation, but and we have Bitcoin trading down. So to the extent that Bitcoin was taking away gold as a, inflation hedge or a fiat currency hedge or whatever, you would think all those things tied together, gold should really be working now. It's moved a little, but what else could you want if you're a gold bug? So I don't know. I still don't get it.
Jeff, you have a theory. You got a chart at the very least.
Yeah, I do. And I'll just start by saying I'm a little bit biased here. We don't hold gold. We really never do. I don't think it's the best inflation hedge. I think the correlation to inflation is inconsistent at best in the near term. But I think maybe the lackluster move in gold price is actually telling us something. I think maybe other assets are telling us the same thing, and that's that inflation is not getting away from us, number one. So the dollar is stable. You've had various commodities already peak. Long-term inflation expectations are somewhere around 2%. And then to your point, the chart. So real interest rates are rising. So in this chart, that's represented by falling TIPS prices. So prices and yields move in opposite directions. So real rates are typically negatively correlated with prices in gold because real rates, as they rise, the opportunity cost of owning gold goes up because they're not giving you anything, they're not yielding anything. So I think that's part of the story right now is that investors are finally seeing real rates rise. They're somewhat of an alternative. So I think in a lot of ways that is kind of a classic sign of a wait on gold prices.